other than the pattern-based entry that I'm searching for in order to take more accurate entries. The difference between breaks in structure and breaks of structure. After a break in structure, there must be... I am looking for where they are trapping traders in an area. Welcome to Pips to Profit. My name is Cameron, and in this video, I am giving you everything that you need to know about reversals and how to trade them. Before beginning to even describe or tell you how to trade a reversal, I need to be able to define what a trend is. Up here on the screen, you're going to notice that these really sophisticated blue lines are going to indicate your higher highs and higher lows being formed. So you have a low, a high, low, and then a higher high. Now, the fractal version of this is the other thing that you're looking at up here, which would be like in this strand of price right here, you're going to have higher highs and higher lows, and then they'll break structure to the downside, give you 3 pushes down, and then continue to go in the other direction. This is what an actual trend would look like typically on the charts, giving you major lows, major highs, minor swings on the inside, and then breaking and going and continuing the major trend in whatever direction that may be. This could also apply to a downtrend, of course. One of the other things that we need to talk about is the difference between breaks in structure and breaks of structure. Just real quick, because it is a bit of a review. Here is the videos that if you want to go back and watch more things about structure and trends and whatnot, these are going to be the best options for you. A break in structure is going to signify a change in direction, whereas a break of structure is going to signify a continuation of a trend. For example, in this example over here, you have lower lows and lower highs being formed, and then they make a higher high. That is going to be considered a break in structure, letting me know that there is a potential for a reversal from that point. Now, I'm not necessarily just going long off of that higher high. I still have a lot of checklist things that I need to accomplish before actually taking the trade, but this is an early warning sign or an early indication to start looking for that trade. After a break in structure, there must be 3 pushes against the newly developed trend. What does that refer to? I'm talking about we're going down, making lower lows and lower highs, and we make a higher high. I still need to see 3 pushes back down into the low before taking that trade. The new extreme being formed is considered the first mouse. This new higher high that is formed will create a first mouse scenario because this gets people to start going long early. These are the people that have the direction correct. They've just timed it incorrectly, and they are going to usually be punished by the market for that decision. The market will come back and stop hunt into those traders, and that is why I have to wait for 3 pushes before making trading decisions. However, a break of structure would be something like where they're making higher highs and higher lows, and then they make another higher high. That would be a break of structure, signifying a trend continuation. Now, the fun thing is, it's the exact same thing that you're looking for. So after they make that higher high, even if it's a break of structure, I still need to see 3 pushes back down before making trading decisions. The most probable and the most successful areas of interest when looking for reversals are going to be from the extremes, from that high or from that low. Basically, whenever the market has built a box, and you want to be trading from the edges of that box. For example, having a 100 pip box could be one of your areas of interest. After 3 levels of rise or 3 levels of fall, once you come 25 to 50 pips to the outside of that box, or even just up into level 3, you're going to notice that that can become a very good area for reversals. Another area could be your previous day, week, month, high and low. So you always have those areas up on your chart. You can use either the pips to profit indicator or one of the other indicators that I've listed in the description below. As your previous month, you can just have those levels up on your chart automatically. You could also have your opening range high or your opening range low, initial balance high or initial balance low. And those areas will also create a box and areas where you can look for potential reversals. You also have the previous day's close and the first hour of your session creating the opening range for your session will also create a box and an area for reversals. Why are these levels the most useful or the most successful? It's because within the daily range, and within the weekly range, and even within the monthly range, once certain levels are broken, such as the 100 pip box, the high and the low of that 100 pip box, which is institutional bank levels, the previous days, months, weeks levels, those are all higher time frame trader areas or zones where those higher time frame traders are trading off of those levels. And us down on the lower time frames, with that understanding, know that that is the party that is currently driving the market, and we call those other time frame traders. The outer extremes is where institutional trading takes place, and because it allows us to keep our risk management very tight. We can keep very tight stops, and the risk to reward is phenomenal. And always wanting to remember at all times that the market only does three things. It breaks out in trends, it breaks out in fails, and then it also will stay inside of a trading range. So when you think about any of these boxes, right, price is always in a box, and because it's in a box, it will only do one of these three things. And we just look for signs and symptoms or signatures of one of these three things happening at certain times of the day and look to benefit from them. Getting a little bit closer to explaining reversals, you have to think about what has the weekly template done, and we can actually start to put all the puzzle pieces together. Things like the weekly template: Monday, Tuesday, Wednesday, Thursday, and Friday. Is it a dump and a pump? Is it a pump and a dump sort of template for the week? Or is it some kind of parabolic range expansion sort of template where they don't come back at all throughout the week and it will just continue to trend? We can think about this as a trend trade or a reversal trade, obviously, which is what we're talking about today, where if we're looking at the template and the market's making lower lows and lower highs and we're watching and looking, if it just keeps making lower lows and lower highs, fantastic. That information is valid. It's making lower lows and lower highs. Not going to look to take that reversal unless some other trade setup presents. However, once they start to present maybe a short squeeze setup, or maybe you get a first green day or a first red day, 3 days of breakouts in the market, or a combination of all of these different things, we can start to look for that reversal trade. In this example down here of Euro GBP, you can see that this market is very obviously making lower lows and lower highs. However, at one point, they make a lower low, and then they actually make a higher high, which is going to be a break in structure or break of structure, depending on if it's the second time they have created a higher high. In this case, there was a low put in place right here where they went lower, and then they actually broke structure, BIS, right here, and then created a second higher high over here on this Thursday. And you can notice the 3 push pattern back down into the low of the day, as well as the low of the week. This example also highlights the difference between a trend trade and a reversal. Notice that lower lows, lower highs, lower low, once you get that break of structure, lower low, we're in a trend. So once they push back up 3 times or 3 pushes back to the high, and you can kind of see it here where they jammed up, paused, push, pause, push. At a certain time of day, if you realize that behavior, there is a potential for a high of day trade back down through the low of the day, or essentially a trend trade using the weekly template and market structure. Additionally, like I said over here, the break in structure, the difference between, hey, we're going lower, and then now we may have a higher high, and looking for the signatures that would prove to me that that higher low is going to be formed and allow me to take a trend trade, or essentially a reversal style trade with trend, because it is a new trend being formed back up through that high of day or through the high of the session, or maybe even a range expansion opportunity of that daily range. In trading, timing is everything, and our sessions are designed so that we are trading during the most optimal hours of the day. That is the time when the volume is in the market. That is the time when they tend to actually move the market. And it seems to be when the algorithm or the institutions or whoever is moving the market around is actually creating candlesticks that moves in a unidirectional fashion, or creating a wider range than other times of the day. A little bit more volatile, if you will. So those session timings are going to be Asian session 8 p.m. to 11 p.m., London session 2 a.m. to 5 a.m., and New York session 8 a.m. to 11 a.m. Now, although those are the trading session times, I specifically focus on the second and third hour of the trading. I let the first hour complete without even really looking at the charts, and then I mark off that first hour high and that first hour low. For example, in the New York session, that would be from 8 a.m. to 9 a.m. I would just mark off the highest point and the lowest point that hour traveled, giving me my opening range for the session. And then in the second hour, I might have a trading opportunity, or maybe the second hour is the break in structure, and the third hour is the trade. But depending on how the market is setting up, after that first hour will give me a lot of information, or really all of the information that I need. And as it says down here, I am focusing on that middle hour. Me specifically, I am focusing on New York session after 9:30. So although I don't take trades in that first hour, and I said that I'm focusing on that middle hour, I still don't take trades or even look to take trades until after 9:30, because that middle hour, that 9:30 equity market open, is usually either a stop hunt or the actual move, and the market will build order flow up until that point, and I don't want to be in the market to be manipulated before then. Another very important distinction to make is the difference between reversals and counter trending the market, because they're two very different things. For counter trend, I am looking for different characteristics and different specific details that would allow me to search for this trade. Some of those details can be 3 levels outside of a consolidation. That could have been an overextended market where we have a major swing low in place, and then they put 3 pushes outside of a consolidation. It could be 3 sessions of rise outside of the previous day's high or the previous day's low. Any of those things would allow me to look for a counter trend trade. What is a counter trend trade? Let's look at this example. Notice that the low, the major swing low, is very far away. And then they come out of the previous day's high, push 1, push 2, push 3. And there has not been any break in structure. The market just went straight down from this point and did not give any pullback whatsoever or any opportunity for us to get into this market. This is an example of a counter trend trade that I would have been willing to take based off of the specific details in the way that the chart is laid out. I would have been on the 1-minute chart searching for the consolidation. I would have looked for a break in structure on the 1-minute chart and those 3 pushes on the 1-minute chart at a minimum to take that trade. If all of those things don't happen, I don't take the trade. The difference between counter trend and a reversal is what happened soon after. Now, notice that we're making higher highs and higher lows, and although they are minor swings and we have our major swing down here, they still made a higher high and then a lower low. This is break in structure to the downside and would allow me to look for 3 pushes back up, giving me that lower high behavior. That would be a reversal. I'm taking a reversal from the high of the week, from the high of the day, or from the high of the session, and searching for a continuation of that reversal trade back through the low of the day or low of the previous day, giving us our reversal. Every time I present my entry criteria, I try to present it in a slightly different way in order to reach as many people as I possibly can. This time I've chose to use a flow chart in order to describe exactly what I'm looking for throughout the process. Before I get into this, if you're looking for a good review of what 3 pushes looks like as objectively as possible, here it is right here. Now, moving on to the actual entry process into the entry criteria as well, let's look at what I'm looking for. 15-minute setup. We're at the area of interest that we're searching for. High of day, high of week. Those are places that we're searching for these trades. And a 15-minute setup would be described as one of those things that I just talked about on the previous slide. Is the market extremely overextended? Am I looking at a counter trend trade? There has not been a break in structure. Or has there been a break in structure or some kind of 15-minute setup like first red day or first green day? A signal day of some kind that allows me to search for this trade. I've got my 15-minute levels in place. That's going to be like the high of previous session, low of previous session, high of first hour, low of first hour, those types of levels. And also, of course, like I said, previous day's high and previous day's low is always a must. On the 15-minute chart, I'm looking for a break in structure. That is going to be my first indication to look for a reversal trade setup. Then I go down to that 1-minute chart and I start searching for basically the counter directional move after that break in structure. For example, higher highs and higher lows, they make a lower low on the 15-minute chart and start to push back up. That's going to turn the 1-minute chart into an uptrend, creating higher highs and higher lows. So down on that 1-minute chart, I'm now looking for them to break structure again. Breaking structure and then giving me 3 more pushes. After these 3 pushes, I'm going to get a chart pattern of some kind, M's, W's, head and shoulders, inverse head and shoulders, triple tops, and triple bottoms. And then I'm going to get a engulfing candlestick of that chart pattern, and that will be my entry every single time. Now, this is a pattern-based entry. There are some other things that I look for in line with these pattern-based entries that will give you far more accurate success in every single trade, and that is where I find most of my edge specifically. Coming back to our Euro GBP example, this is the 15-minute chart. We're going to use this as a bit of a case study. This is from the last week that just traded, and I was able to actually capture this trade. The opening range for the week on Monday, all right, that creates a range in itself. And notice that we have our initial balance low, and they've came outside of that on Wednesday, giving us lower lows and lower highs. Then we had our break in structure on the 15-minute chart, giving us that first mouse scenario. Normally, you would have been looking for 3 pushes back down into the low to take your entry somewhere down here. However, that happened outside of the session, which is fine. Coming into the next day, you can still have a long theory or long bias, but you would still need to see certain things. We're at the low of the week, maybe even the low of the previous week, or maybe even the low of the month. Let's take a look at what happens next. We get a break of structure. They make a higher high. Again, same thing, first mouse scenario, and now I need to look for 3 pushes. Push 1, push 2, push 3. Fantastic, check the box. This last leg on the 15-minute chart is going to put the 1-minute chart into a downtrend. Now let's go look at the 1-minute chart. Here down on the 1-minute chart, notice the chart is making lower lows and lower highs. This is a magnification of the 15-minute chart, that third push that I had just shown you on the previous slide, and they're making lower lows and lower highs. Now over here, you can notice that this low, high, lower low, higher high on the 1-minute chart. Boom, there it is. The very first thing that will initiate my entry criteria, and I start searching for the rest of the pattern to take place. That is going to put a low in place. That is going to create this high after 2 candles have pulled back. I can draw my line. Now I have a box to trade from. I want to see them trade back into the bottom of the box in 3 pushes. So we get 3 pushes back down, a W down at the low of the session, the low of the day, and the low of the current week. And we have the engulfment right here of that chart pattern, down, up, down, engulfment. And then you actually have a pattern within a pattern, a W within a W, where there's a W here, a micro W, a middle structure for the second W, and then also a down, up, down, engulfment, giving you a third W. So it's basically 3 Ws within 1 W, and that any of those entries were acceptable. And then you had opportunities for adding in as that market was accelerating. Now remember, I told you that there's other things other than the pattern-based entry that you just saw on the previous slide that I'm searching for in order to take more accurate entries. This is going to be one of those things. I am looking for where they are trapping traders in an area. You can use this concept on any chart at any time. However, I'm going to continue my Euro Pound case study to help display exactly what I'm searching for on every trade that I take. One of the behaviors that I'm looking for is them to start impulsing candles into an extreme and not going anywhere. I look for psychological behaviors of candlesticks that lets me know that traders are definitely taking that short or even that long if it was going the other direction, and allowing me to see where did they start trapping people so that I can create a bit of a zone and so I can develop a better thesis about where I should be getting into that market. So looking at this chart, I have my times up there, 8, this is 9:30, but look at the candles, right? So this is before the session even began. Look at all of the relatively sized candles, and then that one. That is a climax candle into the low that did not go anywhere. It immediately reversed. Then you have another one right there. Then you have a bunch more that are a little bit higher up there, but there's one down low again. There's one down low. There's one down low. All of these climax candles into the low that are saying, hey, prices should be going lower, and then they don't go anywhere. All right, those are the candles that I'm taking note of, and not necessarily drawing lines on every single one because that would just be incredibly confusing. I take a mental note of where that box is at, and I can even draw it up on the screen at times if I'm having trouble focusing. But that gives me a zone. That gives me a trapping zone where I believe that they are trapping volume. So that way, whenever I take the trade and I place my stop loss, I'm placing it into the zone of where I believe traders are trapped. Because when I take my entry, I am of the belief that traders are trapped and they are no longer coming back. And I do that using my entry criteria. At the same time, I am searching for those pattern-based entries as well as those behavioral patterns that the market is trapping traders at an extreme. I am also looking for time engulfments and time patterns that would allow me to believe that they have trapped traders into an extreme. Looking at this chart, I'm going to point out a couple of times, or very relevant times, that you should be also marking off on your charts and then searching for these same patterns. This is the same exact chart on the 1 minute. And notice that 9 o'clock opened up right here on this candle. And then they immediately drove into the low. Push 1, push 2, and then you have a bit of a push 3 after 9 o'clock. That is an hourly candle opening and driving 3 times into the low. Now, I want you to notice that the impulse candles that have formed off of that hourly 3 push pattern seem to really line up strangely with the pattern that we looked at on the previous slide. Additionally, let's look at another time. Where is 9:30 or 9:45? Here's 9:45 right here. Notice that they opened this candle right here and then drive 1, drive 2, drive 3 into the low. And that's where that reversal actually began to happen, which lets me know, hey, so they started trapping at 9 o'clock, sure, but that's pretty far away. I need to find another time that they've used to start trapping. 9:45 is a very viable option because of the pattern that has formed. I'll say that again. It is a viable option only because of the pattern that is formed and also in combination with the previous method that we discussed. One last thing about this that is not listed because it was difficult to put up there. 9 o'clock lines up almost perfectly with the 9:30 opening time. That is 2 times that have just coincidentally opened up at the exact same place in the chart and then drove 3 times into the low after those times. That lets me know that they are probably beginning the traps below those times. So if I would have drawn a box here, down at the low of these impulse candles here, that is where they are beginning the trap. And once they leave this area conclusively, they shouldn't come back. However, when I'm getting into the market and I'm putting my stop loss in place, for example, when I get in here, or if I were to get in here, or if I were to get in here, I'm not putting my stops all the way down here because I believe people should be trapped underneath certain times of the day. And there's no reason to have that wide of a stop when I believe that the trap should be here, because that's the place where I would be wrong if they were to roll over and keep going back down at that point. Now, I know that this might seem like a lot, but I promise you with a little bit of chart time and a little bit of experience, all of these different things will start to flow together as one. It will just come naturally, and you'll start to notice these things without even realizing or searching for them. Ladies and gentlemen, I really hope this video has been of use to somebody. If it has, hit that like button, subscribe to the channel if you have not already, and you all enjoy the rest of your day.